you're going to learn about. It's called Account Receivable Financing, sometimes called Account Receivable Factoring. And here's why it's so powerful. Because first of all, it lets you sell more. This kind of financing actually lets you give your customers terms, basically pay you over time, making your payments lower and it easier for more customers to enroll and buy your stuff. But then at the same time, with this kind of financing, you can get upwards of 90% of that money right away within 24 hours. So you can let your client pay over 5, 6, 7 months. But then you're able to get 90% of that payment right away, even though they have 5, 6, 7 months or longer to actually pay it back. So AR financing is one of the best kind of financing out there because it does this dual benefit. One, it just lets you get more customers. By keeping your payments low, by letting your customers pay over time, then that helps you attract more customers. And that's really one of the only types of business financing that has a direct program that really helps you get more customers because it makes it more affordable for them to buy. But then the other benefit is that you're getting your money right away. So unlike giving your customers terms and you letting them pay you over 5, 6, 7 months, well, in that scenario, it would take you 5, 6, 7 months to get your money. But with this kind of financing, you can get the money right away and make it convenient for them to pay, therefore attracting more customers. So AR financing and factoring, one of the coolest types of funding programs. And basically, here's how this works. So ultimately, what happens with AR financing is first, you're letting your customers pay on terms. So you can decide, the lenders have all different kinds of terms. Usually, they don't want you to go beyond 12 months, depending on what you're selling. But you can basically let your customers pay over time. And when you do this, this is called an account receivable, meaning that somebody owes you $1,000. They're paying over 10 months. That's $100 a month. Well, when you do this and you collect that first $100, well, the rest is called account receivables, meaning that they owe you that other $900, and that in itself is an actual asset. As a matter of fact, that's the #1 asset used to qualify for SBA loans. Account receivables, AR, is the #1 asset that's used to collateralize SBA loans. So the other cool thing about this is that you let your customers pay over time, you get your money right away, and you're building an asset that makes your business more valuable. AR, account receivables. And that AR can even be used, if you're not using it for AR factoring, for collateral like SBA loans. So for example, the last SBA loan that we got for $500,000, phenomenal term, 30-year term, 4% interest, very low payment, but they needed collateral and they used our AR, part of our AR as collateral. So this AR can be used for a lot of different reasons, including collateralizing SBA loans, but it can also be used to be able to get this kind of AR financing and factoring. So it starts with you letting your customers pay over time. Next is that we're coming in and we're actually finding an AR lender to be able to lend money against those account receivables. Now, typically it could take 2 weeks or 3 weeks for them to look at the receivables that you actually are dealing with to make the approval decision. Now, here's the good news, is that this AR review, this review to approve you, is not based on personal credit at all. They don't even do personal credit checks because they don't care about your personal credit quality. They care about your customers paying you, not you actually paying them. So what they're actually going to do is they're not going to look at other collateral or require it. They're not going to look at your cash flow. They're not going to care about your credit. What they're going to care about is your aged AR report. Like, who are these people that owe you money? Now, they typically want the money to be coming from other businesses or the government, not consumers. So if I'm a lawn care business, for example, well, then with a lawn care business, then I actually, if I'm mowing residential lawns, those people I can't get AR financing for. But I can get AR financing if I'm a lawn care business and I'm like mowing lawns of like big commercial buildings, like where I'm around, okay? Because they're business owners as the client. So when your client is the government, when your client is business owners, then this is when you can typically qualify for AR financing. And by the way, Mike South is in the house from St. Louis. Thanks for coming in, Mike. So we're going to let customers pay over time. We're going to find a lender that will actually then underwrite and approve this for our AR. They're going to look at our customers. Now, typically what they're going to do is they're going to look at business credit quality of the customers that are actually paying you money. Look, let's be honest, this is something you should be doing. You should be making sure that the customers that are actually enrolling to pay you are good, credible people that are more than likely going to actually pay their debts. Well, that's exactly what the AR factor lender is doing, is they're ultimately looking at the business credit quality of the customers paying you to make sure they have a history of paying their bills on time. And what will happen in this review is sometimes they'll come back and they'll say, okay, hey, these people we're not going to accept the AR from, and these people we will. And that means the people that won't accept the AR from, well, it's typically pretty high-risk businesses that have a less likelihood of actually paying you back. And then after that, you're approved. After you go through this 2-3 week approval process, once you're approved, then you could basically submit the AR to them and get paid upwards of 90% against that AR within 24 hours. So again, Customer comes in, enrolls for $1,000, okay, and then we're going to give them 10-month term to pay $100 a month. The AR factor the next day would give me $900 of that $1,000. Even though the client in this example wouldn't pay that $900 for 9 months down the road, the lender is still paying me that $900 in this example right away within 24 hours. Now, the other 10% that's not paid right away, in this example, $1,000, $100 left over, that will get paid when the customer pays all of the invoice. So when the customer pays through all 10 months in this example, pays the full $1,000, then the lender will give me the other 10% minus whatever their fees are. Now, there's a lot of benefits to this, right? First of all, you can get really fast access to cash. So you can get fast access to cash in the future for AR, for customers that pay you. And you might already have AR now. You might already be like we are, and we already have let our customers pay on terms, and we are financing that for our customers. Well, in a case like this, we have millions of dollars of AR. We're able to leverage that AR and get a large sum of money and factor and finance that right now. So you can do this with existing AR that you already have. And then you can also do it with future AR to make it more convenient for customers to pay. Another benefit is there's no personal guarantee. You're not personally liable for the business debt. They're ultimately using the receivables from the businesses that pay you. That is the collateral. So you're not personally guaranteeing this debt. There is no personal credit check in most cases as well. Now, obviously, another benefit is this really improves your cash flow. Because instead of letting a customer pay you an example of $1,000 to pay you $100 a month, well, now you get $900 of that $1,000 right away. So you can let your paid customers pay on time. You get the majority of your money right away. So it really helps you with cash flow purposes because you're not out this money waiting for them to pay you over 5, 6, 7, 8, 9, 10 months time. You're able to get most of that money right away. The other nice thing about this is that the payments are basically flexible. It's based on invoice volume and your customer liability. So basically, if you have more customers, more AR, well, then you're going to be able to get more factoring. And if you have less, you'll get less. So it's really flexible based on what's actually happening in your business. And again, you don't need any other kind of collateral. Cash flow doesn't matter. Credit doesn't matter. The stuff that most lenders look at just doesn't matter when it comes to AR financing. So more benefits of why you might consider this. Now, you can get loans up to $20 million. You can get up to $20 million factored with AR financing. And the interest rates or the factor rates are typically less than 2%. So the longer the customer takes to pay you back, then the more expensive the money will be. But factoring rates for AR factor are ultimately sometimes 1% or 2%. As a matter of fact, it's oftentimes less than you would actually pay in credit card fees if you accepted a credit card from the customer. So it can actually save you money because instead of accepting a credit card from the customer, you can use AR factoring. And sometimes it's less money and less cost than even if you accepted credit cards from that customer as well. And again, the terms are variable. They work with the volume of AR you have. And again, all you need for collateral is just an aged AR report. Typically, the software you're using to collect payments already has something like that. Like we use Infusionsoft to collect our payments. Infusionsoft already has an aged AR report. And this is something the lenders really care about. What the lenders want to see is that you actually are keeping up with your AR, that you actually know that what people actually owe you, right? That's important. But again, if you're using any kind of software to process payments, typically that software has some kind of AR aged report that can actually help you. Now, who are the ideal customers for this? Well, the ideal candidates for this kind of financing is a business that has at least 6 months to 1 year in operation and AR, right? In order for you to qualify, you should be in operation for 6 months to 12 months. The reason for that is because you kind of need to be able to have enough AR accumulated for an AR lender to want to lend against. You should have $10,000 a month in these receivables coming in. Okay, now again, you can get loans up to $20 million, but they don't usually want to just do this for startups. They want to actually see that you have like 10K worth of AR right now a month coming in. And that's typically like the baseline of when they'll start offering finance for you. And again, they're going to be looking for your customers to have good credit history. So if you're dealing with less credible businesses or government, which I guess I should say less credible businesses paying you, it could be a problem. Some of that AR may be received or may not actually be accepted by the AR lender. Okay, and they want to see that you have like a stable business. They don't want to look at your cash flow to make the approval decision, but they want to make sure that your business isn't up 1 month and down significantly the next. They want to see it's consistent because they want to lend to a business that's consistently giving them the AR to actually lend against. And again, B2B businesses is what they're really looking for. So somebody that's accepting customer payments from another business or from the government, manufacturing, logistics, staffing. Doesn't matter what you do. It's just your customers should be business owners. So for example, for us, we could use AR financing because all of our clients are business owners. We don't actually work with end consumers, right? We just work with business owners. So some things to think about: challenges and risks, right? Invoice quality matters, right? So those clients that you're dealing with need to have good credit. Now, the good news for you is that the lender is going to do that decision making for you. They're going to look at the business credit reports of these businesses. So if they tell you these companies are not credible, well, you should be aware, because that means those companies they're not going to accept are less likely to actually pay you. Okay, watch the fees as well. AR factoring sounds very cheap, 1%, 2%, but it's based on how long the money is outstanding. So the longer you're giving your customers to pay, the more money you're going to pay in fees with this kind of financing. So some things to think about. And also keep in mind that this is not ideal for really long-term funding needs. It's more of a way to kind of offset or supplement letting your customers pay on time and getting your money right away. So this isn't going to be something that maybe you want to do permanently. But again, if you look at the biggest factors in the country, the biggest factor in the country is Johnson & Johnson. To give you an idea, pretty big company, right? So really, really big companies use this. Another benefit that I didn't talk about is that the lender actually collects the AR so you don't have to. So if you're letting your customer pay you over 10 months time, well, the lender's the one that makes sure that customer is paying. You don't have to. So you don't even have to have billing involved and collections involved. And all these things you may have in your business now, they're not even necessary because the lender's actually doing that part of the process for you. So you hand it to them. You no longer have to take that over on yourself. And you're really not on the hook anymore at that point, right? So the customer doesn't pay. Well, the lender's chasing them. You're not chasing them. So you're not on the hook. In a lot of cases, like you're not worried about a recourse period like you were with other kind of financing because the lender's doing the collecting so you don't actually have to. Okay. And again, that's a huge benefit because you don't have to have billing. You don't have to have collections. You don't have to have all these problems of chasing your money like you once did before. So again, 6 months time in business is your requirement to get in. 10,000 a month in receivables. You have to have an established customer base that's paying you like through on terms to be able to qualify, obviously. And you have to have business invoices from creditworthy clients. And you should have consistent cash flow. Like the business should be consistent. It shouldn't be like these wild upswings and downswings. So if you're interested in finding out more about AR financing, there's a ton of lenders out there. You can go to creditsuite.com/get funding as well. There we can tell you about all the different types of financing you can qualify for your business. But what you want to do is find that aged AR report. The aged AR report's the main thing lenders are going to look at. And then typically if you have that, then you're able to get within about 2 weeks time a pretty good idea of the amount of money you can get, the AR that they will actually finance, and get all the details you need to actually be able to get approved. So if we can help you along the way, go to creditsuite.com/get funding. If you're interested to find out other types of financing you can qualify for outside of just AR financing, go to creditsuite.com/consult. When you actually meet with our team, we actually use something that we call Smart Fund AI we created. Smart Fund AI looks at every type of business loan and line of credit card that's out there. And then literally we can give you a PDF report that shows you all the financing you can qualify for. We can give you business credit recommendations, credit card recommendations, everything in one report. So like, you know what you can actually qualify for. And on that consult call, we'll give you a 100% free Dun & Bradstreet credit report score. Since we are teamed up with Dun & Bradstreet, then we're able to deliver that to you as well. So if you have questions, let us know here at creditsuite.com. And if you got value from this training, make sure that you like and subscribe and keep your eye out for our next training where we talk about more cool ways to get the money you need to start and grow your business.